Hey guys, Toby Mathis here. Let me start with a warning. If somebody tells you you can buy a property subject to run a cost seg, take bonus depreciation, and wipe out your W-2 income, they're not telling you the truth. They're skipping the part that decides whether you can use the loss. And no, I'm not talking about passive loss rules, using the loss period, because there's two hurdles that you must reach, which sub-2s rarely clear before you can even get to that passive loss rules. So today I'm going to slow this down and explain it like a normal person. I'll show you exactly where most subject to deals break from a tax standpoint. No hype, no guru math, just how the IRS actually looks at sub-2 deals, which code provisions and how losses are actually treated, and I'll give you some workarounds. But let's start with an example. I'm going to use this example throughout the day. So let's say Jill, she buys a $700,000 fourplex. Subject to, she puts $50,000 down. And she does sub-2, $650,000. I'm just going to put sub-2. Easy. She does a cost seg, bonus depreciation. She brings out the land. Let's say that in some of these cases the land value is really low. So she ends up with a, let's just call it a $200,000 loss in year one. Can she use it? All right. To answer, we have to know three basic concepts first. Basis, at risk, passive loss rules. So when you hear, I get a tax loss, the IRS makes you pass these three gates in order. So this isn't a boom, 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 boom. It's a 1, 2, 3. So you ready? I'm just going to write them down so you know what they are. Let's go over basis. Do you have enough investment in the deal to even have a loss? And when I say investment, it's what you bought it for. So do you have basis? Number two, is that loss backed by money you could actually lose? And it's called at risk code 465. So it's the Internal Revenue Code 465. Are you at risk? Could you lose money? Can you actually lose that money? Is it capped? Is it restricted? And then number three, the passive loss rules. Call it passive activity law, however you want to do it. It's 469. You can hear them called PALs for passive loss. Most of the subject to gurus talk about depreciation like it's the whole game. Because, hey, if I can get a bunch of depreciation, I can get this big write-off. Boy, I'm going to get to write it off, and it's this magic thing where you're never going to pay taxes again. Doesn't work that way. If you fail any of these gates, 1, 2, 3, you don't get to use it. Period. So let me explain this again in even easier terms. Think of a tax loss like cash in a vault with 3 locks. I want to get to that cash in the vault. You don't get to the cash until you open the vault, and there's 3 locks on that vault. So lock number 1 is basis. Do I have enough investment in the deal to have a loss? Because if you have no basis, you have no loss. The vault doesn't open. The first lock does not open. Lock number 2, at risk, 465. Okay, it's like this. Okay, how much of that loss is backed by money you could actually lose? If you can walk away and only lose the property, the IRS says, cool, then you only get losses up to the amount that you're truly exposed for. And that's where most subject to hype dies, by the way, because you're not on the hook for it. Lock number 3, passive loss rules, 469. Even if the loss is real and allowed, the IRS will ask, but is it passive? Because if it's passive, it usually can't offset your W-2 or your other active business income unless you meet an exception. What are the common exceptions? Active participation or real estate professional status. But we don't even get there unless we open locks 1 and 2, basis and at risk. So back to Jill. Jill bought the fourplex for $700,000 down. For $700,000. She put $50,000 down on it. So what is her basis? Well, she bought it for $700,000. That's going to be her basis. There's some things that could add up, some expenses, things like that, but let's just call it $700,000. No different than if she'd bought it for cash or if she had borrowed the money from the bank. Doesn't matter. Her basis is the same. So step number 1, Jill has plenty of basis. So the first lock opened. But she's not personally on the $650,000 loan. She did a subject to deal. There's no real recourse obligation. So her at risk, what is she truly at risk, would be that $50,000. That's the amount she could actually lose. Losing the property does not count unless it meets an exception, which we'll talk about in a second. So lock number 2 stops her. So she can't use the $200,000 cost seg loss just because it showed up on paper. Basis lets you create the loss. At risk decides whether you can use it. So Jill could use, what does she have that she's truly at risk for? $50,000. So she would get to use 50, the other 150. So we take the 200. There's the loss, $200K minus 50 that she actually gets. So she would have $150,000 of loss that is suspended. Now we go to lock number 3, passive activity rules, right? And we decide 469. Rental activity is passive by default, so unless Jill qualifies for a special exception, can she even use that $50,000 loss that she was allowed to? She got $50,000, that's what she gets. That's what passed lock number 2. So the IRS is going to ask, well, what kind of income are you trying to offset? And I'm going to go through 4 cases. Let's just call them A, B, C, D. Case A, Jill has other passive income elsewhere. So Jill has, let's just say, $60,000 of positive cash flow from her other rentals. Well, then she could use the entire $50,000 loss from the fourplex that as passive. So she can offset that passive income. So the result, Jill can use the full $50,000 this year. That's easy peasy. And by the way, passive capital gains count too. So if you sold a passive property, like a rental property that was generated passive income, it's going to keep that same nature when you sell that asset. So it has capital gains. You can offset those passive capital gains with the passive loss of $50,000, excuse me, the $50,000 that Jill had. Case 2, Jill has no other passive income. All she has are these passive losses. But we'll just say she has no others. So Jill has 0 passive income, and she doesn't have an exception, the active participation or real estate professional status. So the $50,000 that she was at risk for becomes suspended under 469. Head spinning yet? So we have 2 types of suspended losses. We have suspended loss for at risk, and then we have suspended loss for passive. I'm sure that the sub-2 guru you talked to explained that in great detail. Right. Case C, ABC. Jill qualifies, let's say she qualifies for the $25,000 rental real estate exception, which is Jill actively participates. That's very common. If she's pulling the shots, it's not a issue of how many hours she spends. Is she the one who's ultimately in control? And if her income is low enough, she may be able to deduct, there's a limit to this, of $25,000 of rental loss against non-passive income. Problem is it phases out. And phase out is between $100,000 and $150,000, whether you're single or married filing jointly. It doesn't make a difference. And this is where many high-income viewers, you're going to lose. If you're watching this and you're making over $150,000, you're not going to get this. But if you're under $150,000, you're going to get some of that. So the result, let's just say Jill makes $100,000 a year, W-2. She would get to use $25,000 of that $50,000 against her W-2 income, and the rest would be suspended under 469. Again, it would carry forward. And one of those fun things is carrying forward, you get to use it in the future. Case D, and I think this is where a lot of the sub-2 gurus like to talk. It's real estate professional status, which means Jill is a real estate professional and she materially participates on her rental properties, and meets one of the tests. There's 7 tests. The real estate professional test is really simple. It's, does she work in a real estate trade or business for at least 750 hours a year, and is it more than 50% of her time? If she meets that, she's a real estate professional, and then she has to pass one of the material participation tests. And if she does that, then the entire $50,000 is no longer going to be treated as passive. It'll be treated as non-passive loss. So the result of that is the entire $50,000 that she's entitled to because she's at risk, she would be able to use against her other income. So if she's at $100,000, we used in the previous example, she'd get a $50,000 loss. She'd only have to pay tax on $50,000. Being a real estate professional only matters at lock number 3. If you fail lock 1 and 2, you never even get to that far. So let's talk about those suspended losses, because we had 2 buckets of suspended losses. We had the $150,000, which is $465, and this $50,000 could potentially be $469, depending on the scenario. So we have both. To use the at-risk suspended loss at any point in the future, all we have to do is increase the risk. So how could she do that? Well, using Jill, she could put more cash in the deal. She could put another $50,000 into the deal and increase the amount if she has all these suspended losses. And then she would unlock another $50,000. She could refinance. She could put $150,000 in and use the whole. Or she could sell the property, which would release the loss. To use the passive loss, 2 choices. Increase your passive income or sell the property. You have to have complete disposal. So in our example, Jill had a cost seg that showed a $200,000 loss. But 465 at risk says only $50,000 is allowed. And 469 says, hey, Jill, do you have any other passive income, or do you qualify as an exception? So if you don't, if she doesn't, then even the $50,000 gets suspended. So meanwhile, the other $150,000 is stuck in that 465. She has to increase her economic risk. So Jill can walk away thinking she was going to get a $200,000. Remember, she was told, hey, you get a $200,000 cost seg, bonus depreciation, you get this big loss. Never going to pay tax again. The reality is she got 0 deduction under this scenario. If she didn't qualify for a real estate professional or active participation, she didn't get any. But my sub-2 guru told me I could write it off. He even said I could use it against my W-2 income. What the heck's going on here, right? Well, I get it. You should be frustrated because TikTok and Instagram gurus run off at the mouth without understanding the nuances of what they're talking about. Yes, under the right circumstances, you can write losses off. But you have to pass the 3 locks. 1, 2, 3. Basis, at risk, passive. Now let's talk about how you can do so. In order to do this, I kind of want to step back for a second and let's nail down our definition so we can talk about everything intelligently, because words have meaning. So number 1, debt. Debt is simply borrowed money. So if you borrowed $500,000 to buy a property, that's debt. Someone gave you money, you promised to pay it back. It's simple. But not all debt is treated the same for tax purposes. So there's 2 types of debt that we're really concerned with. There's recourse and non-recourse. So let's start with recourse debt. What is it? Recourse debt means if the deal fails, the lender can come after you personally. Your house, your bank account, your wages. From the IRS's perspective, recourse debt is serious debt because you are truly on the hook, you personally. And that matters to the IRS. What about non-recourse debt? Let's talk about that. What is non-recourse debt? Non-recourse debt means the lender's only remedy is the property itself. If it fails, they take the property. They don't chase you personally. And this is important. Just because it's non-recourse, it does not automatically mean there's no tax benefit. It just means that if it's non-recourse, there's going to be hurdles. And this is where people get confused. But what about secured debt? Secured debt just means there's collateral backing the loan. In real estate, it means the real estate is backing the loan. They can take the real estate. Use other examples. Hey, I have a car loan. It's secured by the car. They can sell the car. Secured by unsecured is not the same thing as recourse or non-recourse. Different questions, different tax consequences. But that's the language. So we have recourse, non-recourse. We have secured, non-secured. We have what is debt. We have all these things, right? But let's basically show how the rules work. So we go back up to the at-risk rules, 465. And this is important because if you are not at risk, you cannot use the losses personally on your return. And I repeat, no matter what somebody tells you, no matter what some online guru tells you, you cannot use real estate losses personally if you do not meet the at-risk rules, specifically 465. So the IRS has one core question that they ask. What money could you actually lose if this deal goes bad? I'm not talking about paper losses or depreciation schedules. I'm talking about real exposure. Under 465, you are at risk for the cash you put in, the debt you are personally liable for. So you remember, not a recourse debt. That's what he's talking about. You're on the hook. They consider that very serious. And this matters, listen to me, because there is an exception. Certain non-recourse real estate debt. There's a special little exception. It's called, let me see if I can do this. It's qualified non-recourse financing. I'm just going to circle that. Qualified non-recourse financing. Again, non-recourse financing in real estate can qualify, but only if you meet the following rules. And I'm just going to break it down. There's 2 that you have to pay attention to. The financing is borrowed by you or your entity from a qualified lender like a bank. Congress created the exception under 465. It's called the qualified non-recourse financing, and this allows certain non-recourse real estate loans to count at risk. That is why you don't have to personally guarantee every apartment loan when you're doing syndications. You don't, right? You could still have large at-risk amounts. Commercial real estate, I mean, that's why it works the way it does, is they allow you to, hey, even though you're not on the hook for it, we're going to treat it as at risk. But the exception has requirements. And this is where it blows up sub 2. To count as qualified non-recourse financing for an activity of holding real property, the financing must be borrowed by the taxpayer with respect to the real property from a qualified person, like a bank or a government. It can't be a related party, and the lender's sole remedy is the property itself. You cannot be a personal guarantor on it. So the phrase that matters most today is the financing must be borrowed by you or an entity that owns the property that you control. And that is not the case with the subject to deal, right? Who is bearing the risk in that case? It's the seller. It's the seller. She took it subject to. Who's on the hook for the $650,000 loan? The seller. So the qualified non-recourse financing does not work with the classic subject to deal, period. So we don't pass lock number 2, which means we never get to 3. Let's walk through our example with Jill. Let's assume that Jill bought this property from Bob. Bob, the seller, owned that fourplex worth $700,000, and Bob has a $650,000 mortgage with Bank of America. So Jill buys the property subject to the existing mortgage. So what happened? Well, Bob he stays on the loan. He signed the note. He's the one who's personally liable. The bank never let Jill any money. So yes, Jill owns the property. Jill has $700,000 basis. Jill can calculate depreciation, but here's the problem. Jill didn't borrow the $650,000. So for 465 purposes, the at risk, $650,000 is not the kind of non-recourse real estate debt that boosts Jill's at-risk amount through qualified non-recourse financing. So the result is Jill's at-risk is often just the cash she invested, plus any true recourse obligation she personally owes. And I put a little underline on that one. Her losses get suspended under 465, that $150,000. They're not denied. They're just parked until Jill actually has more at risk. And so, by the way, some of you guys, there might be some bells going off, going, wait, if we can make Jill more at risk, she can write it off, she could pass this test. Yeah. And that's the trap. You end up with no usable loss today on a typical sub-2 deal. You still have depreciation reducing basis. And by the way, you always get to recapture depreciation, even if you can't use it. So the one line to remember is you can't deduct losses backed by debt you never borrowed unless you're truly exposed. If the lender formally approves Jill as an assumption or an ovation so that Jill or her LLC becomes the borrower, then prospectively, the borrowed by the taxpayer element could be satisfied and she might have a path forward under qualified non-recourse financing. So let's go back to Jill. She buys the fourplex for $700,000, subject to, from Bob, $50,000 down, subject to a $650,000 mortgage for $700,000. Let's just say the existing mortgage is 5.5% and Jill brings that $50,000. There's no assumption, right? Bob stayed on the note. Here's what the guru says. Jill controls $700,000 property and can take a massive depreciation and bonus depreciation. And here's what the IRS is going to say. Hey, Jill, what can you actually lose? If Jill's only real money in the deal is that $50,000, the bank can't chase Jill personally because Jill isn't on the loan, then Jill's at-risk amount is roughly $50,000. So if Jill runs a cost segregation study, creates the $200,000 paper loss in year one, the IRS response is, cool story, Jill is only truly exposed for $50,000. The allowed amount, best case scenario, $50,000. Suspended losses under 465, $150,000. And even if that $50,000 survives 465, it still has to go then to 469, and we still have to run it through the passive loss rules. So being a real estate professional doesn't magically fix a deal that failed the at-risk. So now the obvious question, okay, Toby, how do I fix it? Come on, how do I fix that at-risk problem legally? All right, the fix is actually simple. In Jill's case, she has to be truly exposed to economic loss beyond just losing the property. So if Jill buys the property for $700,000 and there's an existing mortgage for $650,000, Bob's on that note, Jill's only cash is in there for $50,000. There's no personal guarantee. Her at-risk is going to be capped at $50,000. Losses beyond that $50,000, they're suspended under 465. So to fix it, Jill needs to sign a real recourse obligation to the seller, Bob. Same deal, but Jill signs an enforceable agreement where Bob can collect from Jill personally if things go bad. This is not a, hey, you can go after cash flow only, or you can walk away, because that's what they're going to look at as the cap. So example, Jill says, I'll negotiate where I'm personally liable. I don't want to put myself on the hook for everything, but up to $250,000. So now her at-risk amount would be the $50,000 cash plus her $250,000 real exposure. So now she has $300,000 that made it through that at-risk. And then drop down to the passive loss rules. But just remember, this changed the deal considerably. Jill has more risk, but she also gets more reward. To make it better, let's just say Jill signs an unlimited recourse obligation with Bob and secures it with her other real estate. And by the way, when you do that, when there's real collateral backing it, the IRS loves that. So now the at-risk amount that Jill has, unlimited. Easy to pass. Easy to pass. The story is stronger because it's much harder to argue, hey, Jill can walk away and there's no real other assets on the line. Nope. If your guarantee is full of a bunch of escape hatches, like the seller can only go after the cash flow, or you can walk away and clean and walk away from your $50,000, the IRS will treat it as fake recourse and act appropriately. Also, so now we have basis and risk. We still have to deal with passive loss. I know, it feels like a buzzkill. Hey, we finally got through the at-risk. Then we have passive loss. I'm just trying to keep it real. We'll save passive losses, a deep dive, for another day. Now, some of you guys might be a little confused. You're subject to, and you're probably feeling like, come on, nobody explained this to me. Well, if you want to talk to somebody who knows this stuff, just go into the show notes. I'm going to put a link for a free consult. It's really simple. You can talk to a professional and they can walk you through this stuff. Or just go into the comments and type consult. And better yet, if a guru's been telling you this stuff, put in the comments who it is, what they said, put a link to their video, or explain where I could find the video so we can go take a look. Because sometimes they're using messed up terminology, but they're getting to the right area and it just might not be understood. And a lot of these folks, I know a lot of subject to people, they're not bad. They just sometimes, they love to sell the sizzle, and sometimes they forget about the steak. If you have a scenario that you want to run by us, feel free to add it in the comments below as well. Now, I'm sure we can have someone give you direction if you want. And this stuff oftentimes seems complex. And that's because, well, it is, which is why you don't listen to gurus unless they know taxes, right? Life is hard enough with accurate rules, knowing what they actually are. It gets crazy when you have bad information. So I'm going to give you a quick do's and don'ts to subject to investing to make it easy. So sub to investing, do's and don'ts. If you want to be at risk under 465, do make the obligation truly recourse if you're trying to use losses now. Do make it collectible from non-property assets, not limited to just rents and equities if you really want it. Do consider real collateral if the strategy depends on proving real exposure. Do keep documentation consistent. Don't have a side text saying, don't worry, I'll never enforce it. That type of BS. Don't do it. And don't use escape hatch clauses where, hey, the seller's limited in their recourse or collection to simple things like cash flow. Or, hey, the seller's remedy is limited to the equity in the property. Or, hey, the buyer can just surrender the property and walk away. That ruins it. Do not build in reimbursed backstops that erase your buyer's downside. If you can walk away and only lose the house, don't expect a big paper loss in your taxes. If they can take your other assets, now you're talking 465. That's what the IRS likes. You are at risk, but it's part of your negotiation, it's part of the deal, it's part of the calculus that goes into whether you want to do a deal. I'm just telling you how the taxes work. Hey guys, like, subscribe, and share this with anyone that you know who's been out there listening to the Subject To gurus or bad tax advice on Insta or Meta. Feel free to share it. Until next time.